Commercial retail and office space has really been suffering with higher vacancy rates, which has resulted in empty buildings. And this is especially a problem in San Francisco. A national landlord in San Francisco, which owns properties throughout the nation, has defaulted on about $1.7 billion of retail and office space. About half of San Francisco's retail stores have closed in a major shopping square there. It's really bad in San Francisco, but it's also bad across the country. An example is Atlanta. Atlanta is a Sunbelt city that's been growing, population's growing, it has lots of jobs. Since our health problems, people do not want to return to the office. They're suffering. They are going down with their commercial real estate. The commercial real estate that seems to be having the problem because people do not want to return to those lovely office buildings. We are going to have a shutdown of the government if Congress can't come to some agreements of how to fund the government's programs. Moody's, one of the three major credit agencies, has warned it doesn't like what it sees with our political process, how we put on these shows and threaten not to fund the government, and they worry about their bonds being funded and so forth. It's just not a good show. It's not a good look. They're threatening to lower our credit rating like the other two credit agencies have already. We always have that to look forward to. And the deadline is September 30th. You see in the chart, the United States dollar is strong for the last month and it's been going up. This makes it harder for other countries to buy our goods. It's a negative for our stock market. Looking at the CNN Fear Greed Index, we have moved into fear. We were neutral for a while. I think some people are still trying to buy the dip, but most people are fearful of a major market downturn and are laying off stocks for now. The core inflation rate in Europe and in the United States is going down in August and in September, probably. This is ruined by the headline CPI is going to be higher because it doesn't strip out energy and food. You know, you just need energy and food to live. And so they strip that out of the core inflation. It makes no sense. The headline number does include energy and food. It's gone up because of oil prices. Oil per barrel is in the 90s, $90 a barrel at least. It's moving towards 100, and some people are forecasting that it's going to go to 120 or above. So things do not look good. I expect a downturn maybe in November. It's possibly time to buy depending on what inflation shows, but with the government shutdown, gas prices being so high, it's not looking favorable. It is reassuring to hear that core inflation is falling below 4%. That's a good thing, but there's people out there projecting that the S&P could fall as much as 48%, which is really dire. And I'm not that dire. I think there's so much money on the sidelines in money markets. Money markets have $5.64 trillion just sitting there waiting to be invested in stocks. At least a lot of it will be invested in stocks if things turn more favorably. Trueflation.com, as you look at the chart, shows that we have come down dramatically from inflation of last year. I mean, it was almost 10% at one point, and it's come down to less than 3% according to Trueflation, which uses many more sources of data and is much more current. But it is a little bit disturbing that there's been a recent slight uptick in Trueflation's calculation of inflation, which I'm sure is due to gas prices. The personal consumption expenditures, the PCE, comes out on September 29th, which is a Friday, and the core inflation is going to come in okay. It'll come in at 0.27, but the problem, of course, is going to be the headline PCE, which is expected to be 0.51 due to the increase in gas prices. We will not get the September CPI until October 12th. And so we have to sit tight till then. And then the Federal Reserve decides what they're going to do with interest rates on November 1st. It's a really bad sign for the market that some of the market leaders have fallen pretty severely, and they're probably going to catch a recovery bounce, because they've been oversold. NVIDIA came down to $410. Jensen Huang, who was the founder and CEO of NVIDIA, has been dumping shares, okay, because it was down like 26%. Amazon, similarly, has had a fall of about 10% from recent highs. So there's plenty of reason to be cautious. The thing about shorting these things and shorting the technology stocks in general is they are so prone to have a bounce. There's still plenty of people that are waiting for the bottom and trying to buy the dip. And so the VIX, which is a measure of variability, which gets worse when you have a bear market, when you have a down market, the VIX has been well below 20. And 20 is sort of where I draw the line. I have to see at least 20 on the VIX to short the market in general. It just doesn't work very well. You might be able to gain some here and there, but it's not going to be very much, and it's not going to be a steady thing. You don't have a consistently going down market. We have this very choppy market that it goes down, but then it recovers, then it goes down some, then it recovers. You're constantly on the teeter-totter, and you're not really going to make any real money shorting in a market with a VIX less than 20, in my opinion. Short-term interest rates have more or less stabilized. The 2-year bond pays about 5.12%, while bonds on the longer end, the 10-year bond and 30-year bond, have increased substantially. The yield on the 10-year bond is at 4.54%, which is the highest level the 10-year bond has been at since November of 2022. The 30-year bond is even worse. It's at 4.6%, somewhere around there. It's incredible that these rates have gone up this much. That is what's making the dollar stronger as these long-term interest rates go up. And I think they're going up because the Fed is selling off its assets. It's selling off the bonds it has, which has the effect of raising interest rates. And that doesn't affect the short-term interest rates as much as it affects the long-term interest rates, in my opinion, because it affects the market more, the availability of a buyer of the bonds. We have a situation where the long-term rates are significantly increasing, mortgage rates are increasing, and that's why everybody is staying in the house they're in if they can at all, because to buy a mortgage right now is going to cost you substantially more than the good old days. I'm distressed to see that China is such a dominant figure in the solar panel industry. They have pushed solar, and without China, solar would still be a cottage industry. It's improved in the United States because of the Inflation Reduction Act and the tax incentives for people to get solar, but we need to do more with solar. It's expected that the amount of solar is going to triple by the end of this decade. It's a very important part of renewables and making it so we don't have such serious climate change, which is very devastating. The United States actually considers it a security threat that we are so far behind in solar, but we can catch up. But China, they really have put the push on it, and they have done well improving their environment. I mean, 10 years ago, you couldn't see the sky in Beijing. They had so much pollution, and now you can see the sky. They have the capacity to produce 70 times more solar cells than we do. We need to catch up, and this is something that's good for the environment. It's good for the economy. It's it's good to reduce our reliance on oil so we don't need to go to war to ensure our supplies. Please hit the like button and think about subscribing. I think we're going to have a downturn, and how deep it's going to go, nobody really knows, but I think it's going to be significant. And I'm not talking about individual stocks. I don't give financial advice. This is simply what I'm doing. But for right now, I'm just kind of staying out and watching. And I'm a very active trader. I don't see the utility in shorting this market or in trying to triple leverage it either up or down. And I've made lots of money doing both at the appropriate times. But I just see this as a choppy market that really kind of lacks a direction other than sort of drifting down. And until it shows conviction in either going down significantly or going up significantly, which I and everyone else would much prefer, until it does that, I'm just an observer and I'm happy to take my 5%. Thanks for listening and watching.